Welcome to the Money Huddle, a podcast that discusses financial topics for families, retirees, and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Advisory Alpha. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Advisory Alpha may maintain positions in securities discussed on the program.
All right. Thank you for joining us. We've got a very special guest with us today, our Chief Investment Officer up at Advisory Alpha. His name is Steve Osterink Jr. We affectionately refer to him as Junior or Steve or Steve-O, whatever your preference. But Steve, welcome, buddy.
Thank you for having me. Great to be here.
Great to see you, man. So obviously a lot's going on in the world today. We could have our entire buffet of options to talk about, but I think that we'll dive right in. First, I want to share with everyone that's watching the video. Steve recently prepared a nice presentation on a market update, and we're going to have that involved and links to that. So we're not going to duplicate his presentation in our chat with him today. If you want to go watch that, we encourage you to do so. We'll make sure that is available up on our website and in the email that you may have received about this. But to get things going, Steve, obviously the number one topic that people are looking at right now in the news is this situation over with Russia and Ukraine and the potential impacts that they may have on us here in the United States. So really quick, first impressions on that. What are you thinking? What are you guys kind of looking at, and how are we somewhat positioned to be taking advantage of that or protecting our folks from that?
Yeah, I mean, it is a concerning event from a geopolitical perspective, and I think a lot of the risk or a lot of the uncertainty is just really how it's going to potentially spread across different aspects of the world and the markets, et cetera. But from a direct the direct impact that it has is really rather insignificant just on the surface, because it's not like we have a lot of exposure to Russia or the Ukraine, like in the portfolios. I mean, it's a minuscule allocation. So I can, maybe put some people's minds at ease with that comment. And that's kind of universal. I mean, it's not like there's a lot of advisors and managers here in the US that have a large slug of, Russian equities in their portfolios or something. It's not the situation. But I think the fear is, how does this kind of start to change the global economy and sanctions? How does that play out? How long is the duration of this whole thing going to last? I mean, there are some real risks for sure with that. But to me, my biggest takeaway, to just kind of cut to the chase, really is and we actually are just, if anybody wants a copy, we just put this commentary out. We literally just are sending it out here this morning on the conflict in the Ukraine. So if you want more information on that, let me know, or let the Vertex team know. But it's my biggest takeaway is markets hate uncertainty. And we have this string of uncertainty. And I'm just going to get back to the behavioral side of things. Like, we have this uncertainty now with Russia that just came on the heels of the uncertainty with the Federal Reserve saying, hey, we're going to totally change monetary policy now. We hit our employment goals. We're trying to taper inflation. So now we're going to become more restrictive on the monetary policy front, which is a big departure from how we've operated. That just happened. And then right before that, obviously, we still have these lingering impacts of COVID. So, I put this comment in this commentary where I said, uncertainty is not, it's not just purely additive. It's not like, hey, we have 3 uncertain events, add it together. That's how the market digests it. Markets are emotional. Markets are its own kind of little, thing. Uncertainty is more exponential. It's like you add uncertainty, add one uncertain event on top of another uncertain event on top of another uncertain event. It exponentiates that whole uncertainty, and the markets just hate that. So I think a lot of what we're seeing in the markets is hopefully good news here. I feel like it is short term. It's this. There's just a lot to process right now, which is normal in these situations. But there is real risk too for, like I said, how long this thing persists.
does kind of feel like we're in a little bit of a market paralysis right now, like a little bit of a malaise, and kind of in no man's land, because we're not seeing the limit down days that we did during the COVID forced shutdown. It's just sort of this relatively small percentage movements day by day, cut 2% up, 1% down, 1.5% down. And it's just sort of in this washing machine cycle, I think, like you kind of explained. So one of the things that is on the docket for this early year is the Fed's decision that's approaching to change interest rate policy. And so we have come off the heels of a very accommodative Fed policy, from injecting capital into the markets for the COVID lockdowns to keeping interest rates at the bare minimum. Yeah. And that's about to change. And so this does have an effect on our markets here directly. What are your thoughts on kind of what evolved from those 3 years of really hyper growth returns and growth stocks to now kind of where we are today in this transition into a less accommodative Fed?
Yeah, well, I view this again, and I touch on this in the presentation that Michael mentioned at the beginning, but it's a good thing. I mean, we can't be so, the monetary policy really actually since 2008 has been pretty accommodative. We haven't done a lot of tightening. There's been a couple of seasons of monetary tightening through that period, but we coming through COVID, all the stimulus, all the expansion. I mean, we need to get the reins tightened a little bit on that. It's healthy. It's good for the economies. That's how these things work. So, I view this all as a very good thing. And my take, as I look at the equity market returns, I mean, year to date, we've kind of been hovering around a maybe 7 for the broad markets in the US, a range of maybe down about 7.5% to down about maybe 11 or 11.5%. We've kind of, as you mentioned, Ross, we've kind of been hovering in this range, a point up a day, a couple points down, a couple points up. We're in this range. And to me, that feels like, even in the midst of this, the Ukraine crisis here, I mean, I feel like the markets have been processing that event fairly well, given the Federal Reserve tightening. And when I look at that range of -7, -11 in that range, it feels like the markets have kind of priced in what the Federal Reserve is communicating they're going to do. They've been very transparent with where they're going with interest rates, with tapering, they've been tapering the reinvestment back into treasuries. So I think it started at they were buying $700 billion of treasuries down to 80 or something, but they're tapering. They have tapered. They're going to continue to taper, which is good. And now they're talking about raising rates. So that to me feels like equity markets just went, okay, we've been really accommodative. Now we're going to just adjust down in that range because of what the Federal Reserve is doing. Now, they clearly priced in a fairly significant, in my mind, amount of interest rate increases already. But then on top of it, you throw this Russia thing. And I feel like the markets have processed it pretty well, because I feel like this is kind of the natural range for what the Federal Reserve is communicating they're going to do. Not that equities can't drop more, et cetera, but I just feel like that to me was the larger driver of this reset of equity prices lower. It's not this Russia thing. I think the Russia thing is making prices volatile, but I don't really feel like they were permanently brought down 5% equities because of this conflict. That to me was because of the Federal Reserve activity.
Right. It does feel like we've got people's attention on pins and needles, just kind of the day by day of action of what's happening in Russia and Ukraine. Yeah. But the broad market, I think you're right. I think we've absorbed some of this news that the Fed is most likely going to raise a few times this year. They probably will not take an overreaction to raising rates too quickly now, would be in my opinion, just because of the added stress of what's happening in Ukraine.
And that's a great point too. And there's been speculation on that as well. I mean, this event now is clearly causing the Fed to maybe not rethink their strategy. They've actually been transparent that their strategy is still intact. They're going to raise rates, but it's maybe not so aggressive now as what they were originally planning.
So there's a cliche in the market that you don't fight the Fed. And so for the last 3 years or so, it's been a very accommodative policy, pumping money into the system. It's led to some pretty wild speculation in growth stocks and SPACs and IPOs and businesses that aren't really mature and haven't developed cash flow yet. But that might change going forward. How do we see, and we're starting to see this diversion between the value segment of the S&P 500 and the growth segment. This diversion started about 6 months ago where value started to lead. Value has been more resilient year to date than growth by a pretty wide margin.
Yeah.
And how do we see the shape of our core model, just getting kind of specific into our core model portfolio construction? Because there is a high level of diversification. And I do feel like we're interestingly kind of prepared for some of these market movements. Just talk a little bit about kind of the shift into the value component of the S&P 500 and some of the hidden value that's in some of the other segments of our core model.
Yeah. I mean, well, I think first and foremost, it's just such a reminder again of, man, is it easy to get excited about these high growth companies and be concentrated and, just make all this money. But then, you see all of a sudden these returns just getting totally sucked out as some of these companies like instantly when rates go up or when, volatility hits. And, it is just, it's a behavioral thing 100%. But I just, I'm not a big concentrated, super concentrated equity guy. I know some people like to invest that way, but this is just, again, another reminder of that. And I think one of the core tenets of the core allocation portfolios is this boring word diversification, right? It's like you just come back to some of these fundamental concepts, and I just hate it. I've mentioned this before, but it's just, this term is just, it's gotten just all the life kicked out of it because everybody preaches about it and then beats it up. But it's like, you got to do it the right way. You got to use diversification the right way. But, to me, it's making sure we have proper diversification across individual equities, which our core allocation strategies do. I don't want to buy 5 stocks. I don't want to buy 10 stocks. Like, we want to make sure we have enough diversification. But then secondly, to your point, Ross, like, let's make sure that we've got style diversification, like value growth, sector diversification, asset class and asset category diversification with some alternatives, things like gold, things like MLPs and energy, and so we should have a dialogue on some of these different areas, because we have seen a pretty radical shift since the beginning of the year on performance across different areas. Like you said, I mean, we had this stretch of time when growth stocks were just absolutely killing it. And everybody wanted to be there, and it's just year over year crazy returns, and value style stocks were just like, nobody was all that excited about them. And then some of the alternatives, we had the same thing, like things like gold and MLPs and other things were just really not that, and I guess it makes sense, right? When everybody's all excited about electric car companies and, fancy fintech stuff, it's like, it's easy to overlook some of these other market areas. So all that to say, we've seen a radical shift. I mean, we've been balanced across value and growth for a while. We have had some growth tilts in the past, which have been beneficial. But, we do have value very well represented in the core allocation portfolios in terms of the equity, the traditional equity allocations. But then also in our alternative allocation, we're including things like a dedicated real estate allocation. I already mentioned MLPs in the energy space. Those areas of the portfolio are very value oriented, although we consider them alternatives, but it brings a larger value tilt to the overall portfolio. And these are the types of things that year to date, and gold as well, physical gold. These things have done really, really well through the volatility that we've experienced over the last couple of months. And yet these are the same things that people a year ago are like, do we really need that stuff? I want to all be in growth, so again, it's just a great reminder of why we have these types of assets in the portfolios, why we have this kind of exposure. But again, all that to say, all diversification is not equal as well. So we've got to make sure we're implementing that properly.
I think you hit on a couple of things that are really important. One is that as an investment team, you've had the ability to make those tilts shift. So when the Fed was accommodative, we did tilt those portfolios to a growth allocation to try and capture as much of that excess return as we could. We a lot of times can pare down some of those hard assets during low inflationary periods and make them a lower percentage of the portfolio. But then when we look at today, where we have inflation pushing 40-year highs, it's been very pleasant and a good kind of alternative counter to the growth stocks having those hard assets, because it makes sense. We need hard assets during periods of inflation. They've been a good sort of rebound from some of the growth declines to kind of help balance things out in our portfolios.
Yeah, 100%. And we've got to, and you're bringing up this term active management. I speak of active management as a range. Like it's a lot of people will look at active management and assume it is one thing, like timing markets, or other people are much more like buy and hold and they don't do anything. But this is a range of decision making, and our approach to active management is just a balanced thought process there. Like, we're not timing markets, we are making adjustments, but we have this backdrop of foundational diversification that we feel like is absolutely necessary, because nobody can predict exactly what's happening as much as you'd love to think. And we still, every time there's volatility, the older I get in this industry, I've been in the industry now about 20 years, it's almost becoming now humorous to the point, or entertaining, of every time we get volatility, there's people that think, why shouldn't we just get out and then get back in, when things stabilize? It's like, that's not how markets work. I mean, I just pulled, there's studies on this. Like, if you're out of the market for like the 10 best days, over the last however many years, it absolutely obliterates your total return. I mean, there's so much return packed into such small market sessions that, this idea of timing, and maybe you're thinking, hey, I'm not going to time markets, but I still want to be overly active. It's still, if we're too active, it introduces this element of active risk, this manager risk, and people discount that at times, thinking that it's sustainable. So you just have to be measured with your active management and remain disciplined with your approach. And that's what we do. And Ross, to your point, we do make adjustments, absolutely. But we are ensuring we have this foundation of diversification and these right diversifying assets throughout these different seasons.
I think go ahead, Michael, please.
No, I was just going to hop in. I think one of the things that is also part of the conversation is making sure when you are allocating assets or investing, that you're considering the time horizon that you're actually trying to invest for as well. We serve a lot of people that are planning for retirement, and yes, there's some specific things that need to be considered when putting together an allocation for retirement. But people are living, 25, 30 plus years in retirement. And so, the same type of growth that you enjoyed while you were accumulating assets, you still want to have a portion of that, present in your retirement portfolio, especially with some of these other things that we're seeing. But you're right, Steve. We have been in this situation now probably for, I would say, ever since the financial crisis, that scarred so many people that now anytime there's volatility at all, and we've been telling people in workshops and in meetings and whenever we can, with technology and with the way that much trading is now automated, that we're seeing volatility happen very quickly to the downside, but it also happens quickly to the upside. Mm-hmm. And it is extraordinarily difficult to say, well, hey, let's just pull out, because things could turn on a dime, as we have seen. And, you could be sitting out. Case in point is COVID 2020. I mean, that was a really scary period when the market dropped, basically over less than a month. We were down, the major equity indexes were down over 30%, in like 22 trading days was the story that was quoted out on CNBC. But like Ross and I, we've talked about on our podcast, if you just missed like one statement cycle, like one quarterly statement cycle, like you started looking at your statements again in June, July, you might not have even realized like what had just happened, because of the recovery was so swift. And I think that is the key, is understanding hey, if your investment time horizon is correct, some of this volatility, it ends up being very small static in the long run, even though it's painful to kind of endure. So we try to encourage people, don't subject yourself to the day-to-day waterboarding of the financial news media, because they're going to continue with the headlines, because that's their job. Their job is to get eyeballs. So that's just about my thought as you were talking, is like, it's not just, we talk about risk tolerance, but it's also about like, hey, let's think about the right time horizon for investing as well.
Yeah, and one quick bit of this isn't a specific quote or data, but to support what you said, I mean, the idea of short-term intra-year losses. So a lot of people look at calendar year losses in the S&P, and they're like, all right, generally, and if you look, this is interesting, they're up. I mean, it's something like 75% of the time. Like markets are up a lot more than they're down. And to
it's
your
like
point,
4 out of every 5 years are positive.
Exactly. But if you peel that back, the intra-year volatility. So to look at the max losses that occur every year in the markets, it on average, like I forgot the exact stat, but it is very typical for markets to lose 10% or more within the year, yet almost the majority of the years and positive. The point is here, like the kind of volatility we're seeing, it doesn't mean the year is going to end this way. Maybe it will, but if you look historically, the numbers support that we're not. But the idea of having a drawdown in the year of 10%, that's normal. Like that's just a typical part of how these markets work. So, back to your point there, just on being cognizant of time horizon. Yeah, if you're investing for a month or two, or a short period of time, I mean, obviously equities not for you, but we are living longer. We need to depend on equities for longer term growth and to protect against that longevity risk.
Yeah. And another thing that people do that especially, and this comes out, I see a lot in down markets, is the losses become nominal. So it's always like quoted in a dollar figure versus like a percentage of the portfolio. It's like, oh, I'm down X dollars. And we're not going to discount that whatever that amount of money isn't a nice chunk of money, but at the same time, it might actually represent, 6%, we're down 6%, and that's the thing that, we have to just try to be mindful of. But, I'll pivot here to our next topic here. I know one of the things that Ross and we've chatted about, and I think it's probably part of COVID. COVID was so disrupting on so many different ways, but especially in the business cycle, because we literally slam the brakes on, one of the largest economies in the world, forced everybody into, different modes of innovation. And then the reopening has been very disjointed, to say the least. And so we've just seen all kinds of effects on the business cycle. And Ross has even said, hey, I feel like we've had a normal business, the normal business cycle that might go 5 to 7 years has been condensed down into almost like a 2-year period. And we just want to hear your thoughts on that.
The business cycle roller coaster, Steve.
Yeah, I mean, it's weird to say the least. I mean, I think we're going to look back at this. I mean, people are going to look back at COVID and the pandemic in so many different lenses, from a psychological aspect, from a supply chain aspect, from an education perspective. I mean, this is going to it's going to be fascinating to actually see some of the research and feedback, over time as it comes out. But from a business perspective, you're right. I mean, I feel like business cycle, I agree. I mean, it kind of condensed things, but I actually think the technology adoption and innovation may be the single most kind of like largest element to how it did evolve the business cycle, because there was so much, everything stopped on a dime, which was just never, never happened. And then the Fed stepped in and the government stepped. So the Fed moved to a super accommodative monetary policy. The government stepped in from a fiscal stimulus perspective like never seen before. So you had both arms there, the Federal Reserve and the US government doing everything to supercharge it. So everything stopped, which was crazy. And then you had these forces come in and just absolutely just create activity, which that just spurred like that whole thing. If you just stop there, stopping on a dime, having these forces come in like never before, like we've never seen to stimulate. Companies were making so much money, then things were cranking, but natural life was just weird. So it was such a weird disconnect. But then I think it was the technology response, like looking at how companies were forced to staff and operate, totally changed. How consumers were forced to change how they operate. But then from a purchasing perspective, but then also looking at how just everyday life was conducted with Zoom, with the telehealth, kind of stuff, like everyday things. The technology and technology is interesting because technology is a long-term force against inflation. The more efficient we are, that helps keep prices down. And so that's a good thing, but it was compressed. It was so compressed. And, I think that the one of the natural, if you think about technology innovation, it has traveled at this particular pace because it takes time to innovate and it takes time to adopt. But with COVID, it forced both of those things to the point where, Ross, your comment about having the business cycle compressed from a 5 to 7 year period down to a 2 year period, I actually relate that to technology. We had 5 to 7 years of technology innovation packed into 2 years out of necessity. And so that benefited a lot of different types of companies, but it also created like so much efficiency just very quickly. To now to the point where the technology component, inflation still rose. The technology innovation, I think long-term is a good thing because it's going to help actually manage inflation long-term. But the sheer force of the monetary and fiscal response in that period of time is what led to the inflation that we're seeing now. So the technology that we experienced longer term benefit to inflation, but in the short run, we had so much monetary force that came in that spurred on the inflationary side. So to your point on business cycle, all these things were accelerated. Like that's what we're saying. I mean, technology, inflation, even employment, just absolutely started kicking butt because of all these forces coming in. It is fascinating to see how quick that moved. And now we're all of a sudden to this period of tightening. It's like COVID wasn't even that long ago. It's like, I know, right? Like 2 years, right? 2 years ago, we were freaking out like the world's going to end. And now all of a sudden the Fed's like, man, we got to slow this thing down. I
think that's the psychological conundrum we're in. Because it doesn't seem that long ago, but it does feel like when you look back, it's like 7 years worth of activity got condensed into these 24 months. And now we just got to, and the market's just got to take a breather. And I'm kind of encouraged by what's happening right now, even though it's never great. You never want to see negative returns. You never want to see stocks drop. But the reality is, I think we have to let a little steam out of this market. And we're seeing a lot of pistons fire underneath the broad indexes, because the broad indexes, for the most part, the Dow and S&P are still kind of hovering around somewhere in that 8 to 10% decline range. We'll see what today brings. The NASDAQ is a little bit more, which I think is understandable because they did kind of explode out of COVID.
The other thing on NASDAQ, though, quick comment on this, because I think this is good for people to know. Growth stocks are much more interest rate sensitive than value stocks because they're financed more on leverage. So, as interest rates go up, these companies depend on capital. So their cost of capital increases, their cost of loans. So if you're going out and need to borrow, $100 million at 3% versus 5%, that has a pretty big impact on your profitability. And so that's why growth stocks are resetting. But also that was my earlier comment around getting some of these excess bubbly returns sucked out of some of these companies. Like some of these companies just, I mean, not so much in the S&P, but like there was so much private equity explosion and all this over the last few years. And a lot of these companies, they had no money. They didn't have revenue. They didn't have profit, so it was all being funded based on like future earnings. And so when interest rates are projected to increase, those company valuations start to fall apart, which to some degree is good because they got pushed up out of control.
Right. Also, I think a lot of people, and this may start to come out, and I won't name any names, but there definitely seems like there were some of these people that figured out, how to basically package things in SPACs and take advantage of that environment, and in a lot of ways bring companies that maybe shouldn't have been brought to the market, but bring them to the market. So that the VCs and the people who had been on the PE side, they had an opportunity to exit at the I guess at the expense of the retail buyers. And and if you think about kind of like what happened, you were talking about technology. I mean, so many platforms came online, and we talk about the democratization of finance and all this stuff, but so many platforms came online that make it very, very easy for inexperienced, younger investors to get involved in the market. And basically it's you build enough hype around something, and you could attract dollars, and it's so easy just to boom, click a button and start buying. And we were in that kind of environment, and it's exactly like what Ross was saying. Now what we're seeing is, because not to call this environment normal, because that word's going to, I think we're going to argue about what normal means for a really long time. But now that we're in a situation where the Fed's saying, hey, we need to, try to get, interest rates moving back upwards. And, we're seeing this tightening. A lot of these companies that were just kind of built on smoke and mirrors, they had no earnings, they had nothing substantial. The air is just let out of the balloon.
Yeah.
And the people that, brought those companies to market, they probably already exited a long time ago,
Yeah.
and it's in, and Nick Murray just wrote about this. He was like, what a lesson for a lot of these millennials to learn about just how bubbly certain things in the market can be.
Yeah.
And, to be mindful of that when you are getting advice or when you're investing dollars and so forth. So, it's just such a fascinating time to be.
So that kind of was where I was going, right? Because we have the speculative bubble has been pricked. That's pretty clear. We've seen dozens and dozens of companies just do a full round trip from COVID. We've seen the explosion of their market cap, and now it's decimated. A lot of those businesses are down 60, 70, 80, 90%. It's very dot-com era for that segment of the market, where it was a accommodative policy. They had low credit, or it was cheap credit, and it was available, and they took advantage of it. But it wasn't necessarily great for consumers and investors. But I mean, just think about it. A year and a half ago, we were contemplating if we were going to have negative interest rates.
Yeah.
I mean, we were seeing a 10-year treasury in the 60, 70 basis point range. And I think we've had a healthy return back to at least some normalization. I mean, we're seeing the 10-year kind of hover between 1.7 and 1.9 range, eclipsing 2% at one point. I think this is a good return back to, all right, there is some, I'm not saying a bond is necessarily a competition for a stock yet, but we're seeing some yield return. Globally, it's a pretty appealing, we're probably attracting international capital to those bonds, which is helping us, the Fed unwind. And I think if there's an encouraging output, it's like some of the speculation has come down. We've seen rates start to increase a little bit. We've suffered through some of that pain already as investors. And are we better prepared now for the next cycle than we would have otherwise been?
Well, and you touched on a couple of things, but I want to just reiterate, globally, the U.S. still has, generally speaking, in developed countries, the U.S. has a much higher interest rate than others. That's attracting capital. It strengthens our dollar, which has other implications. But that's the reality. And a lot of these other developed countries have emerged out of negative interest rates, which is nice to see globally as well. But our rates are higher. But I think you touched on yield curve. So the relationship between short-term rates and long-term rates, even as the Fed has been giving guidance on what they're going to do with short-term rates, because the Fed funds rate is a short-term, they can control the shortest term rate. But then it's up to the kind of the yield curve for longer term debt to figure out like how that impacts things. And what we don't want to see is an inverted curve where short term rates go higher than long term rates. That's a really bad thing. And we saw that in the 70s when we had accelerating inflation. And so that's a very big difference today. Now, and hopefully it stays that way. And it looks like it will. So even as the Fed has been really aggressive prior to the Russia conflict, they were, I mean, I look at it, I don't know how much more aggressive you can be when you're like, a double, a potential 50 basis point rate increase at our next meeting. Like that's extreme. And, we're speculating at like many rate increases between now and the end of the year. Like it was pretty aggressive. Now it's kind of tapered because of the Russia thing a bit, but still they're doing that. So, but why I bring that up is when the Fed speaks, the markets listen, and short-term yields went up because you have to understand, again, markets, bonds, stock prices, they are a leading indicator, right? Like they are going to predict what's happening. So if the Fed's saying they're going to do something, these asset prices like reflect it like so quickly. That's just how these things work. So the fact that the short end of the curve did go up, the yield curve flattened, which is natural. I mean, if the Fed says they're going to raise interest rates in the short run, it's natural to see a flattening of the curve. We saw it, but we also saw longer term rates kind of increase at a lesser to a lesser degree than short term rates. So it went up in the long end of the curve as well to keep our curve normal. And so I don't want to underemphasize that because that's a very, very big deal. If we saw an inversion of the curve, that would be a lot more concerning. So the fact that the Fed was this aggressive with their communication and that the yield curve is still normal, that's really a great signal to the strength of the markets. But yeah, to your point, nobody likes volatility and all that, but we have to look at some of the longer term factors at play here.
Well, as we kind of like wrap up the conversation, I wanted to get your thoughts a little bit, and this is something you speak about in the presentation. So someone, again, we'll have a presentation we'll make available that that Steve put together on a lot of these topics, where if you're into data and if you're into numbers and you're into kind of some specifics, that presentation is for you. But one of the things that is constantly talked about, and then we're going to hear about it frequently because it's an election year, is the national debt and the deficits and the deficit spending that's going on in Washington, combined with the rate increase. And that, again, we led off the conversation with one of the things that people don't like is uncertainty. And we've been going through uncertainty on top of uncertainty. And that's kind of created this churn that we've been in for a while with the market, just trying to make sense of things. But can you just share a couple of thoughts on what you see as far as the deficit spending that's happening, current debt in the country, and just how we could be looking at that as investors, and how that might be impacting us moving forward, kind of a forward looking opinion, if you will.
Yeah. I mean, that's a big topic. I mean, in 2021 and in the presentation, so check that out. I think it's a good dialogue. But in 2021, we kind of unfortunately broke some records in terms of the Federal Reserve's balance sheet, our country's debt to GDP ratio, our national debt in general. Like, I mean, these are things that you kind of know, I mean, without even saying it, that it was going to have a big impact 2021 because of all the stimulus. I mean, you're talking trillions upon trillions of dollars, never happened before. The good news is we have seen some of that kind of improve more recently, and I speak to that in the presentation. It's still a problem, but we are seeing improvement to some of these different things. Some of these different financial metrics. And I think we're just in a time right now where, and this is so hard because politically Congress has, we've got to just get more we've just got to get smarter with how we use money. I mean, we can use money, we can have debt. That's not a bad thing. But it's become a little bit, in my opinion, a little bit too frivolous, like it's easy to throw money at things.
You get a check and you get a check and you get
right.
a check. We've been doing a little bit of that.
Yeah, we don't. Okay. And we don't, I mean, I'm sure there's crazy studies on this, but it's all the committee stuff, like you don't run your personal finances that way. Most people don't, but when you're part of a committee and you lose the connectivity between how it impacts you personally, the decisions tend to shift a little bit. So yeah, but it's it is, we are starting to see some improvement in terms of the deficit, in terms of debt to GDP ratios. So I'm encouraged by that, but my hope is that we can just get a little bit more restrictive with how we're spending money, and we can get out of it. I mean, and we can continue to see things improve. And I think the Federal Reserve has a responsibility as well, which we're seeing from them on their end, to make sure that they do the same thing, that they shrink their balance sheet. Their balance sheet has exploded because they've had to create capital, create money to buy more government bonds, to fund the stimulus that the government wants to do. And so now they're kind of unwinding that, or just not rebuying those bonds as they mature. Right. So we're starting to see the right things. That's why I'm not disappointed with the Federal Reserve's actions, but we do have to see that being carried through on the governmental level as well, from a deficit spending perspective.
It does handcuff the government a little bit on how high they can let rates go. Because as you alluded to in the presentation, even a 1% increase in their cost to borrow could send their annual expense from somewhere in the 350 billion range to 650 billion.
Yeah.
So there's a little bit of wiggle room, but not a lot.
Yeah. And I put a stat in there around if the government refinanced 100% of its debt at a interest rate that's 1% higher than it is today. Yeah, it would effectively approximately double their the interest expense. Now that's unlikely. You're not going to refinance all that debt at once, but the point is, like, over time, as that, if we maintain this debt load, or if it increases and rates are creeping higher, that would effectively be the impact from a budgetary perspective. So the debt service could drastically increase as a percentage of our budget as a country, and we don't want to spend money that way.
It's possible over time that becomes our largest line item.
Yeah,
servicing our debt.
Yeah, it could. It very well could increase. I mean, it was the same thing that we saw with Social Security and stuff. Right. I mean, originally it wasn't nearly the size that it is today. Right. So these are the things, to our point, again, just we got to get ahead of it, and we've got to try and manage that.
Awesome. Well, we want to say thank you, first of all, for just taking a couple minutes and hopping on here with us. And we've got Steve's presentation. It's teed up for you as well, but for the clients that we work with and people we serve, one of the things we talked about in this presentation was technology. And Steve isn't in our office with us in Fort Mill, but technology allows us to get his smiling face on here. And so we hope to have him on more calls with us and make it available to you moving forward, just so because we do have a very robust team that we work with. And so we want to make sure that that we have great professionals that help us as we allocate assets and make planning decisions with our clients. And so, Steve, just a big thank you from me and Ross.
Absolutely.
And for anybody that, if you watch this and you've got follow-up questions or anything, or dare I say, if you would love to just be on a conference call with Steve, we will do our best to make sure that we can arrange that in the future. So thank you again, Steve. And for everybody else, we'll see you soon.
Thanks so much.